Another most important technique is the break-even analysis. So, a break-even analysis is a financial tool which helps to determine at what stage of a company, could be new services or a product, or even it could be a new company itself which is manufacturing something which gets into a profitable mode. Another definition is it's a financial calculation for determining number of products or services of a company should sell to cover its cost. Cost could be fixed cost as well as the variable cost. We look at what is a fixed cost and what is a variable cost. You need to understand what is that. Break-even analysis or break-even is a situation where you're making money. Money in the sense profit. You'll be making money, but at that point you're not actually making a profit or not actually making any loss. That means all the costs, that is again the fixed cost and the variable cost, are covered. So components of break-even analysis, there are two costs. One is the fixed cost, the second one is the variable cost. So what is a fixed cost? Fixed cost is the overhead cost. So it is basically like all your plant, machineries, or even the factory premises where the manufacturing happens, the production unit. Even if you are going to produce only just one unit, there is going to be cost incurred in case of the land, building, the machinery which needs to be used for producing it. Maybe the rent for the building, it's going to happen whether you manufacture or if you don't even manufacture the product. You need to pay the rent for that commercial or the building complex or for that factory. So you cannot do away with that. So that is a kind of a fixed cost. And similarly, if you have invested on the machinery as well, whether you operate the machinery or not, yes, you have invested. That is all that is fixed cost. Whereas the variable cost, yes, it will increase or decrease direct relation to the production volume. Could be the raw material, packaging cost, fuel, other costs related to the production. The raw material is one which is going to be directly proportional. The more you produce, maybe instead of 1 unit, 100 units, then 100 units raw material is going to be there. Similarly, if you're going to sell it across, you need to pack it, those costs is going to apply as well. So if it is only just 1 unit is produced, yes, the variable cost is less. So you need to, manufacture in such a way that you are able to cover the fixed cost and variable cost, and that is the point where it is called the break even. Suppose fixed cost will be fixed, but variable cost will slowly increase, and you will get revenue. But once you get a revenue, you'll be covering both the fixed cost and the variable cost. So that point is called the break even. So this is a formula you have. One is the contribution, which is selling unit per unit minus the variable cost. So that is the contribution per unit, that is for 1 unit. And finally, the break even is fixed cost divided by the contribution unit will give you number of break even in quantity. So we look at that with an example. This graph provides you much more clarity about the break even point. So fixed cost, whatever this cost, you are not going to change at all. This is going to be there, fixed cost. Whereas the variable cost, I mean, when you produce less, say for example, this could be like 10 units you are producing, this could be for 100 units you are producing, you break even. When you produce just 10 units only, you are still in the red, you are still making the loss. Whereas as you increase and reach 100 units, you start making profit. You cover the variable cost as well as the fixed cost. And anything above than that, more than 100 units, just an example, more than that units, you are going to end up in profit. So this is better explained through this. Total fixed cost is about 1 mil. Again, it is in INR. You can have it whatever you want, USD, if you want, if you're comfortable that way. And the variable cost is 600, and the selling price is the variable cost is 400 and the selling price is 600. So the contributing margin is 200. 200 is the contributing margin. So finally, the break-even units, so that will be 1 mil divided by 200, which is about 5,000 units is what one need to produce, considering the variable cost, fixed cost and selling cost plus the fixed, the total fixed unit as well. So 5,000 is the unit, and the selling value is into 600. So this is the total sales value that should happen for the, in revenue terms. It is about 3 mil to have a break even. And again, the more the contributing margin, even you can sell lesser units as well. If the contributing margin is going to be less, then you need to sell more product. So that is where all this, in a business, all this, the total fixed, the fixed cost, the variable cost, the contributing margin, all plays a critical role in determining what is going to be the break-even point. So with that gives you a fair idea about the break-even analysis, and it is quite critical. If you are getting into any kind of project, after doing the market analysis, thinking about what is the investment to be made, fixed investment, and what is going to be the selling cost, and then you determine, determining the selling cost itself is quite tricky. Determine the selling cost, and then you determine at what point of time you are able to break even. Whether you are able to, the point is, if you are, whether the market can really absorb 5,000 units in the first year itself. All this needs to be analyzed, and that is again a different ball game altogether. You need to decide whether there are customers to absorb 5,000 unit, whether they can in the first year itself, or if in the first year if it is going to be less. All this needs to be taken into consideration. But the underlying point is, yes, the break-even analysis is a critical tool to determine whether to go ahead with the project or not. Thank you. Stay tuned.